Hello, my trading gang. I hope your week is going well. We had quite a volatile market, I would say, in the last 2 days as we getting close to the elections. Probably there's going to be a lot of back and forth. I would caution you as traders as we get closer and closer and closer to the election day to unwind your positions, and basically days before, 2 to 3 days before, to really maybe start trading a lower quantity of future contracts. And after that, as we start counting and the day of, we should expect some volatility until such time that we know who won. And then even then, we don't know how the market is going to react, right? Because we don't know what the market has factored in so far. Sometimes I try to look at the markets and see which candidates they prefer based on things and so forth. This time, I just have to tell you I have no opinion. So I just ask you to exercise caution. So today I'm going to talk about time as a factor in trading. So time is something that is not going to resonate well with investors because they obviously looking long term, but this is more of an argument that should appeal to futures traders or any leverage product out there that you trade. It could be an option that you're in, it could be a forex market that you're in. So anything that has to do with leverage, I think that timing is extremely important, clearly because of risk. But before I'm going to talk about timing, I want to talk about something else. And I like asking people this question. So I like to ask them, what's a profitable trade? And obviously a profitable trade for, I would say that 99% of the people, and so they should, or 99.99 would say, well, it's when I buy high and sell low, or if I sell high and buy low if you're short, if your position was short. So either one of those things would be a profitable trade. But if you're not going to look at a trade in terms of money, or you bought or you sold, I would ask, what is a profitable trade if you didn't consider amount gained? Right. So if you took the gain out of the equation, what is a profitable trade? So many times I explain that, where basically a profitable trade is where you were able to get into the market where there was some sort of an anomaly. What is an anomaly? Anomaly is something that the market mispriced, or the market is not calculated right at that point in time where the level is at, and basically you go in and then the market corrects to the right level, therefore you profit. So for example, somebody who trades divergences, right? So if there's a divergence in the market, they look for those where the market all of a sudden shows overbought or oversold, and they're trying to time the market. Obviously sometimes you could be wrong, clearly, but if you're right, the market all of a sudden corrects itself to the upside or the downside, depending where the divergence occurs. So this is just one example of taking advantage of an anomaly. Or you could be somebody who trades based on statistics, which is a little bit more sophisticated, maybe not, it sounds more sophisticated at least. It doesn't mean that if the method was in Excel spreadsheet and uses statistics, it's more sophisticated, but let's just assume that, somebody, for example, could put a statistical formula on the price and say that the price at this point in time is deviated, from its average or from its mean more than it should, right? And then they take a position and then the market again corrects itself. So what you have to do is basically look at profitable trading, not only in terms of, a gain, a financial gain, but you should also look at it from a perspective of you took advantage of timing in the market. Clearly, you have to have a risk management plan, because just because something is overbought or oversold, it does not mean that it can't get further overbought or further oversold. And quite often that's the case. quite often when the market just drops all the time and people trying to pick bottoms just by guessing, will they truly find out that the market can be a lot more, I would say, it's a lot more, could be a lot more oversold than what it should when people panic. Or if they buy, the market goes up, the enthusiasm level could be higher and higher. So what I wanted to basically mention through all this, that when you try to guess spot those anomalies or divergences, timing is extremely important. Let me go into a little bit of a deeper, kind of go into the depth of timing. So let's assume, that you found some sort of let's not call it sophisticated words like anomalies, but you find some where the market is basically, mispriced. Okay, so you assume that the market right now is mispriced. Now, let's assume you are trading a 5-minute chart. Okay, so your calculation was based on a 5-minute chart. And you go in, right? So the question is, how long do you stay in the market? Okay, from that point on. So a lot of people would just put kind of their stop loss, they put their profit target, and then they just sit and wait, right? If it doesn't hit, it doesn't hit. Since I mentioned stop losses, just have to tell you, legally speaking, that just because you put a stop loss does not mean necessarily that you'll get stopped there. Sometimes there are very difficult market conditions and market could gap substantially from your trade, and sometimes it's even hard to get out. So having said that, again, you put your stop, you put your target, and you sit and wait. Now let's assume that 30 minutes went by, right? So you got in, 30 minutes went by on a 5-minute chart. Now, does it make sense? This is what traders don't ask themselves. Does it make sense to be in a trade for 30 minutes, waiting for something to happen, if your decision was based on the 5-minute chart? So in my personal opinion, no. If you based it on a 30-minute chart, sure. So the question becomes, how long are you in a trade? So usually I have the 3x factor. What is the 3x factor? If you are basing your decision, let's say, on a 5-minute chart, you should not be in the market more than 15 minutes. Now, this is my personal opinion, okay? If you have yours, I respect it. And I don't just say it, I'm not an arrogant guy that says, my truth is the universal truth. It's not. I just have a certain opinion that I've developed over time that helps me to analyze the market. And there could be somebody else with a different opinion. So I always going to pay respect to those who oppose things. It's fine because they have a different experience with the method they built. In my personal opinion, again, if you are basing it on a certain time frame, which is X, it should not be more than 3X. So if you're in a 5-minute chart, you should not be in the market more than 15 minutes. If you're trading 3-minute charts, then you're basically 9 minutes. If you're 15 minutes, then you could be 45 minutes. Now, why? Why is the time so important when we are discussing all of this? Why is it 3x? In my personal opinion, well, if you go back to the argument of the market being mispriced at a certain point in time, and you base this mispricing on a 5-minute chart, if the market did not correct within the next 3x time, within the next, let's say, 5 minutes, 15 minutes, it means that anomaly is gone. That mispricing is gone, which means the opportunity is gone. So you don't have necessarily have to wait for a profit or a target to get out. That's really my main point. That, if you're just sitting there and you're just waiting for the target to hit or the loss to hit, and the market just kind of sitting between them, 15 minutes, 20 minutes, 25 minutes, what you're actually missing out is really on new opportunities in the marketplace. It means that you're just staring at something the opportunity is gone. So it is better to get out. Now, what I'm saying about the 3x, again, it's my personal opinion. It's the most that you should have. Sometimes I've spoke to some traders that ask them what their opinion is, and it's interesting because they do it intuitively already, right? So it came to them kind of intuitive with the time factor. They didn't even think about it, but some of them do it 2x, right? Some of them do it 3x. There are some that I've read about, and somebody mentioned some traders to me that do it 4x. So they would wait 20 minutes, which is fine too. Look, again, the key is that from all this is not that you go at the end of the day and tell me whether you're using 2x, 3x, 4x, or 5x. You can decide whatever you want. But the idea is to recognize that that every single trade that you aim for profit, it means the market has to correct in a certain way to that level from that trade. Even if the market is trending, let's say there's a certain speed that it's going, and so people measure momentum, and that momentum, while it's there, you're trying to capitalize on it because you think it's going to go in a certain level. So even at that point in time, in my personal opinion, as far as the trader is concerned, the market is mispriced and would still, has a potential to go higher, and then you go in and you take your decision. So again, it's important to know which time frame do you trade. Now, some people look at 5-minute charts, 15-minute charts, and 30-minute charts. It's important to have a number of time frames for support and resistance, but they will make their decision on the 5-minute chart. Or you could have somebody with 15, 30, and 60, and they will make it on the 15. Maybe they'll make it on the 30. It's up to them. But the point is they have 3 time frames that they're looking. Some are shorter, some are longer, just for the support resistance. Ideally, you want support and some sort of a support or resistance hitting on all time frames. But again, you make your decision on the 5-minute charts when the range is there as far as your profit and your loss that you're determining. So again, start integrating the time factor into your trading. And the reason is, so first of all, you don't get chopped, right? So, most of the time, if the market is just stopped, so hopefully your loss does not get hit. If your profit has been hit, great. But most of the time, as we know, it's Murphy's Law. So you're stuck in the trade, you're losing time, you're losing opportunity. And if the market, obviously increases its volatility from the moment that you got in, potentially you might get out, with a loss. I always look at things not from a pessimistic standpoint, but in trading, I look at it from a risk side, right? So the risk side is assuming not sitting there and hoping and praying that my profit would hit, but rather saying, okay, if nothing is happening right now and my potential for the profit is gone, I might as well get out. And that's also a part of cutting your losses short. Cutting your losses short does not always mean that, you're waiting for your stop to hit, and just because you had a small stop loss, that's the only intention of cutting your losses short. Clearly, time is a really important factor in your trading, and the length of time that you're in a trade, it should be part of your analysis. What you will learn over time, that's kind of funny. What you will learn over time, that when you actually looking into the time factor of your trades, of how long you're in a trade, you start seeing a pattern, right? You start seeing a pattern of, hey, my stop losses get hit after 10 minutes. And my profit targets get hit after 15 minutes, or vice versa, whatever the case is, right? And then you start seeing, okay, you know what? During this certain volatility, it takes 10 minutes for my profit to get hit. Out of, let's say, 10 trades, 8 were hit within 10 minutes. And then you start realizing that under the current environment that you're actually trading, it takes 10 minutes. And if 10 minutes have passed, then, maybe there's no point, right? Because that's what your method dictates. Maybe there's no more point of being in the market and might as well get out before your stop loss gets hit. So again, it's just another factor to look at that a lot of people don't look at. Now, clearly, one thing I have to mention is that during certain volatile times, you will have different times, right? I mean, you will have, so sometimes 1 month, your profits could be 10 minutes, and, if the market are very volatile, you see that the profits get hit in 5 minutes. So you can't always use one number as universal for the rest of your life. You obviously have to look at the volatility and say, you know what, times have changed. Before, the last 10 trades were 10 minutes, now it's 5 minutes. It could be 3 minutes if it's very volatile. As I said, we're nearing, election time. So again, be extremely cautious about this. Same thing on the stop loss, right? Same thing with there. So you could say, okay, most of my stop losses get hit within, let's say, 5 minutes. Okay, just making it up, right? So just using arbitrary example, that if I'm in the trade 5 minutes, most likely if it passes that, I'll get stopped out. So now you have an indication on that as well. So a combination of the profit and the losses in terms of timing is extremely important for the average trader. Now, I have to tell you that majority of people do not use this factor. And it's just unfortunate that they don't, because I think it's so important, because if traders look, somebody could be a beginner for a month, or somebody could be a beginner, after 5 years, depending on how much time they dedicated and their experience. But it's just rather unfortunate that the time factor has not been pushed a little bit more by those who measure performance of trading, right? How long are you actually in a trade? Because the longer you are in the trade and nothing is happening, your level of risk going up. It's not the level of opportunity that goes up, it's actually the level of risk that goes up. So for example, as we mentioned before, let's say the average of your trading profit, let's say it's 10 minutes. If within 10 minutes there is no profit, at that point, every single second, just increases your level of risk that the market will go against you. So again, I would say start integrating it into it. So just to let you know, one of the things that I've done on Optimus Flow, which is our own platform, I've actually spoke to our programmers and I have asked them, to insert something in a functionality that is called, time and trade. So basically it's something where you go in and you put your symbol that you want to be in, and then in terms of seconds, you will determine, the market would alert you, that whether, whatever the market is doing in terms of time. So let me just explain it again. Sometimes I start thinking about it and I lose my thought. So that didn't come out very clearly. Let me say it again. So you choose the instrument, and then you choose the time that you want to be in a trade. So we based it on seconds. So just to give you an example, let's say, something like 15 minutes would be 900 seconds, right? So you say, okay, so I want to have an alert after 19 seconds. Now, you can then mention if you want this alert to be only on a positive P&L, a negative P&L, or any type of P&L. And basically, when that gets hit, the time that you're in a trade, then it actually tells you, pops up a button that says, okay, do you want to liquidate and cancel all your positions? So basically, you could go in, you can put your profit, you can put your target on every single trade, but then the next thing that you can do is say, okay, I want to be in this trade for, let's say, 5 minutes, okay, which is 300 seconds. And then you want to see the position, let's say, only if it's negative, right? So if it's negative, territory after 5 minutes, you want to liquidate everything. So again, you can choose to liquidate whether it's on a profit based on time and a loss, or basically liquidate just after time, right? So what I do, I use the functionality of time and any P&L. So I don't look at, so I if I was to do it, I would not look at positive or negative. I would just look at any type of P&L, and then you can see the P&L. P&L stands for profit and loss, and then determined by yourself. Now, the reason that I've done both positive and negative is because when I spoke to some of experienced traders, they said I really should have both to determine if I'm in a trade. For example, some traders said, well, if I'm in a trade more let's say than 5 minutes, and it's profitable, and and the momentum is still strong, then I would continue being in a trade, which is fine. Some people do that. So what they say is basically, look, if I am in a profitable trade and it passed but it didn't reach my target, it's fine. But if the momentum is still there, I want to stay in the trade. But if it's in the negative territory, then I don't want to stay in the trade. So again, it's up to you how you factor in the time thing. And again, one of the things that I try to do with Optimus Flow, our platform, is really to add functionalities, not indicators. I think that indicators are, for some people, are extremely important, but what I try to do is really add those factors that I think would be extremely important in terms of risk management and order management. So this is what I do. In any case, I would suggest you try out, those of you who are trading on Optimus Flow, there's a little bell button at the top, and if you click on it, you would see that there's a bunch of categories, and it says P and L alerts. Some of the alerts are for time and trade, and some of them are actual profit and loss that you can also give yourself a target for the day, or a target, as far as profit or loss. So that's extremely important. In any case, I hope that this was educational for you. You don't need necessarily an alert like in Optimus Flow. I just made it easy for traders so they can choose it and it's automated, but you can also have your watch. If you want to look at your watch and do the same thing, it's fine. It is what it is. I like to program things into a platform, and so it's just, so I don't get distracted and I actually get an alert says, hey. And one thing that I noticed, with this time alert, is just the time flies. I mean, I know this is not a class on philosophy, right? And people say, yeah, sure, time flies. Kids grow, and my dog is already 10 years old. No, I'm just saying, like, minutes on the market, how fast it is. Like, how fast. So I think it's really important to start looking also that you will be surprised how fast this alert, even if you post it for 15 minutes, when you're actually staring at the market, how fast it all of a sudden pops up, or even if it's 5 minutes, and you're like, I can't believe 5 minutes have passed. And you know what it did? That kind of an alert gave me a perspective. It even deepened my belief that time and trading should be measured, and it should be part of your matrix. So a lot of the metrics, metrics of trading metrics. So let me give you an example. So a lot of people measure profits and loss, risk and reward, Sharpe ratios, all those Latin ratios, and basically one of the things that, that they want to come up with is basically decide if the risk to reward is really worth it. If they're trading, how much risk do they take for X amount of reward? But I think time should really be a factor. And again, after I started using this alert and played around with it, one of the things that came to my mind was like, wow, today at the age of HFTs, okay, at the age of algorithms and everything else, this time factor, in my personal opinion, is extremely necessary. The reason is because if you look at algo trading, okay, algo trading, it's the thing that it tries, and HFTs, the thing that they try to compete with is also time. When the first HFT started coming and made a lot of money, then over time there was a diminishing returns because other people came in and also spotted the same opportunity, right? So algorithms, what they try to do is really see mispricing in the market. Now, some of them use things that you don't have advantage of, right? I mean, you don't. They could, for example, look at two stocks traded on two different exchanges around the world and see that with the conversion rate and the way they're trading, the one, let's say, in one country it's cheaper and in another country is more expensive. So simultaneously, you have an algo that could buy in one country and sell in another. And then it's a trade and it's a match. And they locked in their profit. So it was based on time. Now, us retail traders, we don't have this opportunity. Now, let's say this is more of an arbitrage type opportunity. But let's say that the market, let's assume that, there's an algo that during earnings season, there was some sort of a, surprise announcement after the market. There was somebody who lost a lot, right? So they also, what they want to do is capitalize on it as soon as the market reopens, right? So let's say the market closed at, let's say 5 o'clock Eastern time. Let's say the earnings, well, I think earnings come out at 4:30, 4:15, not sure. Check. But, let's assume that that's the time that it came out and then the market reopened, let's say E-mini S&P at 4:30. Then the algo wants to take advantage of it as soon as possible. How does it do that, right? So basically, they have the ability to look at the price, look at the earnings. The algo decides if it's mispriced or not mispriced. Again, remember, what you're looking for is some sort of a mispricing and anomaly opportunity. That's what trading is all about. It's finding the overpriced and underpriced, right, for that moment in time. If you have a different opinion, please post it. I'm always open-minded. I also learn from people. But the point is, even those people rely on time. So they have to do it in a timely fashion. Now, I don't know this as a fact, but I believe, and logic dictates that if they were not able to capitalize right away, they're not going to sit on this position, until the next day, carry it into the overnight and the next week. That's not how they work. If they weren't able, then the opportunity is gone. So what I want us to do as traders is also think along the same lines in terms of time. So the same way they think of time, they want to capitalize on it, we should do too. And we should also measure the time. Now, again, we can only do as retail traders with what's available to us. The reason that I put this time alert in Optimus Flow is because I wanted traders to realize also the time is important. That's number one as a factor. And also start measuring, right? The idea is that if you use this tool, this time alert that we built in Optimus Flow, you will start observing, how time works in your trading, and hopefully it would help you in your trading. Now, I know I mentioned also HFT in all this. HFT is a completely different game. It's a game that's based on time. There's also arbitrage opportunities there where they're trying to look at mispricing between assets, or it could be the same assets around the world, or it could be even between micro E-mini S&P and the E-mini S&P. What you'll often find is that sometimes micro is priced, one tick differently than the E-mini S&P. Now, retail traders shouldn't even attempt to take advantage of this because you don't have the speed or the expertise. But just to tell you that other people, if those arbitrage there, they rely on time. But that's more execution time as opposed to measuring. But let's say that they were not able, okay? My point is that they were, if by the time they sent the trade, the market corrected itself, right? And right now, there's no winner, there's no loss. They're not going to stick around there and make, a lifetime investment out of it, right? Like some traders do. So some traders, the worst thing that they do, the worst, when they come into the market, decided they're day traders, and they should close their positions every single day. And that's also time, by the way. Time is also deciding how long you're in a trade for a session, for that, not only in terms of trade, but understanding that when the market closes as a day trader, you should get out. Now, what do most traders do, right? Well, I shouldn't say most. I take it back. Not most, some. And even the ones who do it, I don't judge you. I understand emotions can take a toll. So essentially, let's say they had a trade, they had a good day, but one trade didn't go their way and they don't want to end up in the negative. So they carry the position, if they have the margin, into the overnight. And what happens? Many times what happens is basically, the trade would simply go against them. Right? So again, I always say, look, if you decided you're a day trader, stick to day trading. Day trading does not mean that you're in a trade for 5 minutes or a minute or 40 minutes. What it really means is basically that a day trader, you have to be out by the end of the day session. Refresh your mind, right? And basically, in the next day, instead of being biased, wanting the market to come back in your favor, you have a fresh, new opportunity to look at the markets. Okay? I digressed a little bit, I understand, but this is also the topic of time. So time is not only how long you're in a trade, it's basically the sessions that you trade. So again, in conclusion, start factoring time into your trading. Don't sit there, okay, with your trades, rolling your thumbs, and hoping that the trades will hit. Be active, watch it. Again, if you want to use Optimus Flow, maybe this functionality exists in your trade, in your platforms. I'm not sure. But if you want to use Optimus Flow, obviously go to our site, www.optimusfutures.com, and Optimus Flow is in the platform section. If you need more details, call us. It's 1-800-771-6748. 561-367-8686. Again, a reminder to the old, the new, and the upcoming traders that there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. Please trade only with risk capital. And the one thing I would have to mention here is that what I'm trying to do is really for educational purposes in order to help you in your journey in futures trading. I am not claiming to be the best trader out there. I'm not claiming to have the best returns. I'm not claiming anything. What I'm only trying to do is really help the community of traders out there that instead of going and learning from God knows who out there, at least you'll hear a voice of somebody who's actually dealing with the markets and traders on a day-to-day. And the topics that I bring, in my personal opinion, are practical, not theoretical, and they're something that you should consider and utilize. And on that note, I wish you an awesome day. Thank you for listening. If you didn't skip through anything, actually listen through the whole thing, you're champions. So again, thank you, and I look forward to hearing from you. If you have any questions, we have a community site. It's community.optimusfutures.com. Go there, register, ask your question. We'll answer it. Again, our site is www.optimusfutures.com. You can call us at 1-800-771-6748. Local is 561-367-8686. And if you're listening to this on YouTube, please click the like button. I would really appreciate it. It helps. It gets the word out there. The Google algorithm likes the likes, right? So, and if you're listening to this over some podcast service, whether it's Apple Podcast or Spotify, any of that, please put a good review. We're trying really hard with the Optimus team. Again, I wish you an awesome day, and I'll see you on the next podcast. Take care.